In this video, I'm going to run through some of the top index funds you can buy in 2025. I'll show you options that will let you invest all over the world, including funds that cover really popular indexes like the S&P 500. Now, on top of this, I also want to show you some of the best ways to find ETFs and show you what you need to look out for when you're choosing your investments. There are literally thousands of index funds out there, and I want to help you make the right decision that's best for you. So after I've gone through the selection of funds, I've made a section at the end of the video which is all about helping you find and making sense of some of the technical jargon that you might see. Now, just before we jump right in, all of the funds that I speak about today are going to be ETFs or exchange traded funds, which should mean they're available on pretty much any investing app or platform that you want to use. I'll show you the apps I use during the video and let you know how you can open an investing account if you've not already got one set up. Anyway, let's start right at the top with global index funds. Now, as the name suggests, these funds let you invest in the whole world and can give you a slice of thousands of different companies. I'm personally a really big fan of global index funds as I think they're the true definition of what being a passive investor is. Just think of it like this. All a global index fund is doing is taking all of the world's largest public companies and then sorting them on a list according to their size. So the biggest companies go to the top of the list and the smaller ones go to the bottom. Most of these companies are going to be based in the US as that's just where the largest companies happen to be. But then you'll also get lots of other companies based all over the world. For the core part or even the whole of your investing portfolio, I don't think most people can go wrong here if they just use a global index fund. So here's two options for you. First up is Invesco's FTSE All World ETF. You can find this ETF if you search its ticker symbol, which is FWRG. This fund tracks the FTSE All World Index, which means you get companies from both the developed world and the emerging markets. And inside the fund, you have more than 2,300 companies represented. If you ever want to see what's inside the fund, you'll want to make sure that you download the fact sheet, which might not be available on the investing app you're using. Now, a quick Google can sort that though, and you can see all of the key information that you're going to need. It's worth saying that this fund is an accumulating fund, it won't pay out any dividends, and it has an annual fee of 0.15%. It's also a newer fund that hasn't been around for as long as some others, but it has assets worth more than £600 million. If you do want another choice, which I've used before, then Vanguard also has an option, and this fund can be found if you search VWRP. It tracks the same global index, however, it's been around for a lot longer and has way more money invested inside of it. Now, it's slightly more expensive with a fee of 0.22%, but then some of you might be happy to pay more for the comfort of the Vanguard name. I'll leave that part up to you to decide, as always. Anyway, to make your life easier, I've created a pie which you can copy on Trading 212, which I'm using for my own stocks and shares ISA, and during this video to show you these funds. It's called Own the World, and I'll leave a link in the description below. I'll also leave a link if you want to get yourself started investing with Trading 212 and open your own stocks and shares ISA. If you sign up using my link, you can get a free fractional share worth up to £100 once you complete registration and deposit just £1. Also, if you've signed up in the last 10 days and not received a free share, you can use the code Toby in the promo code section of the app. Right then, next up, let's talk about the S&P 500, which is probably the most famous index in the world. This won't need much of an introduction, but briefly, the S&P 500 is an index of the 500 largest companies based in the US and includes all of the largest household names you'll probably recognize and use every day. There are loads of choices when it comes to finding an S&P 500 index fund, and almost every investing company has made their own version. I think it's quite easy to get mixed up when you choose one of these, so just be extra careful to make sure you pick the right one. I'll give you several options here that you can take a look at. Now, first up, there are two popular ones here from Vanguard, and I know many people out there are already invested in. These are Vanguard's S&P 500 ETFs with two versions, which you can find using VUSA and VUAG. The difference here is just that VUAG is the accumulating version, and that will just reinvest dividends at the fund level. I've personally got VUAG in one of my investing portfolios, as I prefer to just have all the dividends reinvested without seeing them hit my account. Now, both of these funds have very low fees of just 0.07% per year. They're hugely popular, and I have a lot of money invested in them, so buying them, selling them is not a worry for me. Now, as well as these options, let me show you one more, which I believe to be the lowest cost S&P 500 ETF that you can buy in the UK. This is the State Street SPDR S&P 500 ETF with the ticker symbol SPXL. Now, if you Google this, do not get this mixed up with a US fund with the same name, which uses leverage. This UK fund doesn't use anything like that. So if you Google it, make sure you do the UCITS ETF at the end, as I can already see the comments about this one in the future. Now, the standout thing about this fund is the ongoing cost of just 0.03%. That makes it the cheapest S&P 500 ETF that you can put inside an ISA, a pension, or a general investing account here in the UK. Just compare that to the Vanguard fund for a second. Even though that was already cheap, this is literally less than half the cost, which is pretty crazy. What this means is that over the very long term, more of your money will keep working for you and less of it gets drained away in fees. The more money you have invested, the more you'll save in fees. Anyway, on a side note, I've also shared a Trading 212 pie that I've called Cheapest S&P 500. And I'll leave that as a link in the description so you can find that as well. On a final note, whether you choose to go S&P 500 or the world, I've done videos on that in the past to help you, and you can find them all on my channel, which I hope you've already subscribed to. Anyway, let's move on. The next set of ETFs cover the emerging markets. So these are investments that let you invest in some of the biggest companies across countries like China, India, and Taiwan. Now, it's worth saying here that the emerging markets only make up around 10% of the total value of the global stock market. However, they do cover a huge portion of the world's population, and many people believe there's far more opportunities for growth here when compared to the rest of the market. However, it's had a very rocky ride, so just be very careful if you're going to invest in markets that are a lot less developed than the US and Europe. Anyway, with that said, here's two Vanguard options that cover the FTSE Emerging Markets Index. You have VFEM and VFEG, with the usual difference that one of these pays a dividend and the other doesn't and just automatically reinvests. You'll notice that these funds carry higher fees than other areas of the market, and this reflects the higher costs of doing business in other parts of the world. It's still not expensive based on historical standards, but always keep an eye on those fees. These funds both come in at 0.22% per year as their total expense ratio. Remember, on any of these fees, they're all baked into the fund themselves. Platforms like Trading 212 don't charge any account fees to use their ISA, and they don't charge commissions. These fees are charged by the ETF provider themselves, and they're all baked into the price. Whether you own an ETF for 6 weeks or 6 years, it's all prorated based on that annual rate. I'll look to do an updated guide to fees and charges this year where I go into more depth, so look out for that and make sure you're subscribed. Right, next up, let's touch on a very popular index over in the US called the Nasdaq 100. This is a list of the top 100 companies that are listed on the Nasdaq exchange that are non-financial. So this means that you're talking about mainly companies who are big in the technology space. This index has had a great track record as big tech companies have dominated the returns of the stock market for the past decade. However, just be warned that it can also have a lot more volatility as well. The ticker for the version we can buy in the UK is called EQQQ. It's the Invesco Nasdaq 100 ETF, and it has a fee of 0.3% for the year. This is the highest price we've seen so far, but then you wouldn't really mind that when you look back at its performance. It's worth saying that this index is very concentrated in just a few big stocks, which could be a good or a very bad thing, depending on how they perform in the future. The top 10 stocks make up more than 50% of the index, with companies like Apple and Nvidia making up more than 8% each. If they do well, you'll do well, but if they don't hold up, then expect things to be a bit more of a roller coaster. As a quick note, remember that all of these stocks are already inside of a global index fund or the S&P 500 already. The only difference is the concentration and the weightings. Now, I've made some videos before explaining this in some more detail, so go hunt them on my channel after you've watched this one. Okay, next up, we're now going to get a little bit more interesting, and we're now stepping outside of what I would call the traditional passive index fund. There are literally hundreds of funds out there that you can invest in, which cover every area of the market you can imagine. The current hottest topic of the moment is everything around artificial intelligence, semiconductors, automation, and robotics. And as you might have guessed already, there are ETFs that let you invest in companies who are competing in all of these different sectors. I'll show you a handful of these now and pop them up on screen so you can just see what kind of things are available. As I just mentioned with the Nasdaq 100, these ETFs in these sectors are going to be way more concentrated and a lot less diversified than your traditional index-based ETFs. They're likely going to be a lot more volatile, but they could also have the opportunity to outperform the rest of the market. In the most recent past, lots of these funds would have done very, very well, but absolutely none of this past performance is relevant to you if you start investing in them today. That goes with any investment really, but always remember this because almost every ETF that performs the best in any given year ends up performing worse in the following year. As much as I'd love to make 30% every single year, it's just not possible in the very long run. I need to do a much longer video on this topic as I don't want to see people just chasing the ETFs which have performed the best most recently. It's something far too many people do and it never ends well. Make sure you're careful when you select these and make sure you have a look exactly what the fund is invested in. This next section should give you some more tools to actually help you. Right, as promised, this section of the video is about how to find ETFs and what you need to look out for when you're searching the apps or platforms that you're all using. Firstly, I'd say that you will need to use more than just your investing app to actually do your research, as not everything is easy to find. A good place I like to use is a website called justetf.com. It's totally free to use and you can basically search and filter out different funds to get all of the relevant information. For example, if you want to find funds which track the FTSE All-World Index, you'll just need to go to the ETF screener, you click Find ETFs, go to the section here on the left where it says Matching Indices, and then find the FTSE All-World. You'll then get every ETF that tracks this index and you can sort it however you like. For example, you can sort it by the size of the fund, the expense ratio, or even whether the fund pays you a dividend or not, being an accumulating one or a distributing one. You can also search funds by different themes, regions, goals, you name it. So I'll leave you to play with it and fill your boots. Anyway, once you've found a fund that you like, here's my quick checklist of things worth looking into just to make sure you're happy before you find the fund on your favorite investing app. Firstly, I need to find the version of the fund which is listed in pounds and listed on the London Stock Exchange. You can buy investments from the European market if you want, but then you're going to have to pay fees to convert your money every time. So this, in my opinion, is just a pointless added cost. To double check this, I'd go to the stock exchange section and search for the right one. In this case, I can see the ticker will be VWRP, as this is listed in pounds and it's on the London Stock Exchange. But as you can also see, there are loads of other versions in different currencies and different exchanges. Step 2, check the fees. Make sure you're happy with them and compare them to other similar funds if you want. Fees are really important to try and keep as low as possible, but then you also want to get good value. So don't just shop around based on fees alone. Step 3, check the size of the fund. If you're investing millions of pounds and the fund only has a few million inside of it, then you might struggle to place an order. For us normal folk though, as long as the fund has got lots of money inside of it, we should be fine buying and selling as we please. There's no magic number to look for, but hundreds of millions and billions of pounds in a fund will allow for plenty of liquidity. Step 4, check the method of replication and how the fund tracks the index. Sorry if this bit is a little bit more technical, but there's always devil in the detail. There's basically two ways a fund can actually track an index, a physical way or a synthetic way. Now, physical replication means the fund actually buying those shares themselves, and synthetic can be done by using other financial products like swaps. I always prefer to see physical replication where the fund is buying the shares of companies in the index. And I don't mind physical with some sampling, as I appreciate that not every provider needs to buy every single stock, especially when an index has thousands of companies to try and track. There are pros and cons on this point, but my preference remains to see physical shares. If you compare two funds with one using physical replication and one seeing synthetic, you will usually see a small difference in performance. However, just note that if one year a physical fund beats a synthetic fund, it doesn't mean that it'll always do this. Nothing ever works as simple as that with investing, I'm afraid. Now, finally, I'd also want to make sure that this fund is tracking the right index and doing what I want it to do. For example, this fund is a fairly simple one, as it's tracking the FTSE All-World Index, which covers almost the whole world. However, other funds might track indexes which say the world in them, but then only track the developed world. Or another example might be that the index being tracked could be some very obscure one which has just a few stocks inside of it, with a very weird way of being put together. Now, I only bring that part up because you do see this now and again in more specialist ETFs, but this isn't something you have to worry about when it comes to global funds or funds following the S&P 500. For more technical ETFs or specialist ones like AI or robotics, just check what's actually inside of them and see if you agree with the way they've set things up. For example, I checked an AI and big data fund and the top holding was Bank of America, which to me just makes no sense at all. Now, those are the main things I check personally, and I want to make sure that I've checked the key information document as well. You can find these on your platform easily enough, and they hold all of the important information that you need to know before making your investment. Once you get your head around these things, investing does become simple again, but as you can see, it can get very complicated if you start to dive into all of these different things. This is yet another reason for me, at least, to keep things simple and stick to index funds that cover the world, or at least most of it. But as usual, just do what's right for you. Anyway, I hope that part was useful. I've not covered lots of different indexes in this video, and I've left out loads of information, and this is where you can come in down in the comments section. If there's an ETF you use or an index worth mentioning, drop it down below and help each other out. For example, I've left out talking about the UK, dividend ETFs, and even ones that track things like gold and commodities. Maybe I'll talk about them in a future video. Anyway, if you want help with some tips for beginners, feel free to go and watch this video here, which is my beginner's guide to investing. Or if you want to see what I invest in at the moment this year, follow this video here. I'll see you in the next video. And as always, happy investing.